Hey everybody, how's it going today? I just want to do a quick video on the current state of the market and the economy. I made a couple of moves to sell this week, and I just wanted to let you know about it and why I made those decisions and what I think is going to happen to the market going forward. And I'd like to get some feedback from you guys if I could. With this current run-up in the market, I've gotten a little uneasy with some of my positions, and I just wondered if some of you guys are seeing the same things or if you're seeing something different. Okay, right here I have a current daily chart of the Nasdaq Composite. Now, as you can see, the Nasdaq since 2018 frequently goes on very tight, steep moves up, followed by rapid moves down. As of right now, it's currently just a few percentage points away from the all-time high. I'll put some trend lines and some arrows on the chart so it jumps out a little bit more clearly. The current trend has been pretty much straight up since mid-March and is up over 50% from the low. Now, I'm thinking this market is way overdue for one of its steep moves down. And if the Fed hadn't announced the move to buy bonds last week, I think we would have gotten it. As of right now, though, we're still in rally mode, but the cracks are beginning to show. One thing that really sticks out about the current rally is how steep the incline is. As you can see on the chart, the trajectory has been much steeper than the others, and these extra sharp moves are not sustainable. Now, I'm not saying we're going to new lows on the Nasdaq, but odds favor a big move down should be right around the corner. Now, I'm thinking this move down is probably going to be about 10 to 15%, and it should find support around the 8,300 to 8,700 area that I have highlighted on this Nasdaq chart. By then, the Fed's probably going to step in and announce some more stimulus. And I think the Fed already anticipated this move down because of how quickly they acted this week to come in and help. Now, the big news I alluded to earlier that spiked the markets higher this week was that the Fed announced plans to purchase more assets to shore up the financial markets, but this time, they say they'll be expanding its purchasing into the corporate credit market to buy individual corporate bonds in the secondary market. In case you're not aware of it, the secondary market is just a marketplace where investors go to buy and sell bonds instead of the primary markets. In the primary markets, the proceeds from the sale usually go directly to the bond issuer. So in other words, if you're a buyer of bonds, the Fed just threw its hat in the arena and now you have them to compete with. Or another way to put it is certain corporate bonds now have a support floor from the Fed. So any move down in these bonds most likely is going to be short-lived because the Fed's going to be stepping in to buy them up. Now, back in May, the Fed announced they would be buying bond exchange traded funds, or ETFs, as part of the stimulus effort to support the economic turnaround. Now, by buying bond ETFs, they're providing support to the corporate bond market as a whole. But this latest move opens the door for them to target specific companies with their buying. This makes me wonder if they're preparing for something big about to happen in the corporate bond market. Now, one more thing I wanted to point out is that there's been a flurry of reports saying that the virus is starting to spike up in many states. Health experts had previously stated they expected the illness to taper off into the summer like the flu normally does, and then possibly have a resurgence in the fall and winter, but it looks like it may not taper off at all if these reports are accurate. The White House is saying that the fear is overblown, but we should know more in the coming weeks. I think another uptick in the virus could potentially cause another downturn in the market, but I don't think it'll be as sharp or as deep as the first one. The main reason I don't think the sell-off is going to be so severe is that because the fear of the unknown is already behind us. We already went through it once, so I think we know what to expect, but it's definitely something I'm going to keep my eye on. Now, I decided to trim a couple of positions this week. First, I'll go into the reasons why I decided to sell, and second, I'll go into each individual stock and why I chose those ones to sell. The first reason is being what I talked about a little bit before, is that I'm thinking this rally has gone way too far too fast. It looks like the market is pricing in an absolute perfect recovery, so if there are any unfavorable surprises along the way, that could lead to an avalanche of selling. One of my favorite pieces of data that I like to look at is called the Buffett indicator. And the reason I like it is because it's so simple and straightforward, and it's done a very good job indicating when the stock market has been overvalued and undervalued since 1950. All this indicator does is measure the ratio of corporate equities to GDP, and the only time we've had a higher reading was the tech bubble of 2000. Right now I'm going to flip through some historical charts of the Dow Jones Industrial Average and show you the subsequent moves that followed the highs and the lows that occurred in the Buffett indicator. Okay, right here I have a chart of the Dow Jones Industrial Average from when the Buffett indicator made its first signal in 1953. And as you can see, that would have been a great time to be long stocks. Now, if I fast forward to the high reading the indicator put in 1969, you can see that that would have been a much more difficult time to make money in stocks because the stock market went sideways to down for several years afterwards. Now, looking at the Dow Jones in 1982, when the Buffett indicator had another reading in the low 30s, this was an absolutely amazing time to be long stocks because the Dow had its biggest run ever all the way into the tech bubble of 2000, where the Buffett indicator made its all-time high of 159.2, and the infamous tech wreck was a result of it. The second reason I'm trimming some of my positions is more of a personal reason than a technical one. And that reason is I bought a little bit too much during the downturn in March and I'm dangerously low in cash. I didn't intend to draw down that much cash, but prices kept falling and I'd been watching a few stocks like Square and Illumina for a long time. So when the price kept falling in those, it felt like Christmas and I couldn't help myself. Now, before these sales this week, I was under 5% in cash, and I like to have between 10 and 20% in case unexpected bargains show up. Now, in hindsight, I got lucky because the market got a nice bounce up not long after I bought, but if it had a shallow bounce and then rolled over to lower lows, I would have been, for the most part, out of ammo. If the market does roll over hard from here, I'm going to try to be more patient this time. Now, the third reason I'm selling is because I'm just not as excited about these two positions as I was when I bought them. Now, when I finally do decide to pull the trigger and buy a stock, I like to hold for years. So even though I made a little bit of money on these sales, I don't really consider them victories because I like to hold positions for as long as I can and make double, triple, or more. Now, sometimes things change, so I'm constantly reevaluating my positions. I'm not bearish on these stocks, I'm just not as excited as I once was, and I decided to sell half of each of these positions. So I'm still holding a little bit, and I might re-enter if prices come back down. The first position I decided to trim was Uber. Like I said before, I only decided to sell half, and I sold at a price of $33.74. Now, I bought two different blocks back in March, and the average price I paid was $16.18. So technically speaking, the remaining half I own is essentially free since I got a little more than double for the first half. Now, the main reason I'm selling is because I think the economic shutdown put more of a hurting on their bottom line than I originally anticipated. I think their business is going to take a lot longer to get profitable than I first thought, and if the economy does turn back down, they're going to be burning through too much cash. I still think they have the ability to raise cash, but I think it's going to be much harder this time around. Another reason I'm losing my love for Uber is because of the threat from Tesla or other companies that are working on full self-driving technology. The more I think about this threat, the more it makes sense to just sell all the position, and I might just end up doing that soon. I thought before I might get a few good years of high growth out of Uber, but with the delay in profitability because of the economic shutdown, that window has shrank substantially. The second position I decided to sell was Carnival Cruise Line. Now, Carnival Cruise Line is a straight turnaround play. I don't think they're going to go bankrupt, but I think this turnaround in the stock is going to take much longer than I originally anticipated. Now, I sold half of this position as well, and I got a price of $20.69 on the 16th. And my average cost on Carnival Cruise Line was $18.84, so that one's practically a wash. Now, I still think Carnival Cruise Line is a pretty good long-term play, but I needed to trim something, and I don't want to sell anything else right now. I'm also not ruling out rebuying Carnival Cruise Line if price falls under $10 again. Well, there you have it, everybody. So I think I'll end the video right there. Let me know in the comments sections if you agree with these sales or if you think I'm out of my mind for selling these so soon. Before you go, make sure you hit the like button, and if you haven't already, subscribe so you don't miss any future videos. Thank you so much for watching all the way to the end, and until next time, take care, everybody.